Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for October 2nd, 2022. I want to start off by saying that make sure you register for the Trader Summit event, October 21st through 23rd. It's free. You have to register because if you take a look at the panel of speakers that we have for this event this month, it is amazing. And you guys, it's free. It's free to attend. There's so many great speakers that are going to be there. It's a 3-day event. It's online. So make sure you register. Like I said, it's free to register. Even if you can't be there for a day or, maybe you are traveling that weekend, register anyway so you can get the recordings as soon as we publish them. And so I just want to make sure that you all know we just launched this site. So it is available. This is our fourth Trader Summit event, and they've all been a huge success in the past. There's so many great speakers and so many actionable ideas. So make sure you register. Let's get into the markets and let's talk a little bit about what happened last week. Well, first of all, the sterling hit new all-time lows. Now that was, we were bearish on the sterling. We looked at the sterling and we said, okay, well, it's in a bearish trend, and you guys probably remember being in a nice down descending channel. We're at the bottom of the channel. We're like, well, you're right at channel support. And then all of a sudden, the gilt market came unglued. And if you didn't see the bond market just completely fall, it fell pretty aggressively. We'll go into yields here in a minute, but that really took the sterling down. Now, we did see a bit of a recovery. Well, actually, a really nice recovery by the end of the week because the Bank of England stepped in. They were doing some longer dated purchases, so basically yield curve control. And what that did is it did stabilize the gilt market. It stabilized the sterling, and the pound bounced back to where it should, basically to its starting point. But I've got to ask, you this question because I'm not so sure. Is this the time that you want to be a buyer of the sterling? I'm not 100% positive about that. I think it's more of a dollar story at this point. But one of the things that I need to point out here is I believe the way we have to look at it is that that now we are seeing central banks step in, and as a result, you have to start being a little bit more careful with what you're doing. So, let's take a step back, and we're going to look at all of these charts. We're going to look at a little bit of longer term charts. The reason why we're going to do that is because the stock market, if you didn't notice on Friday, we closed at all-time lows. I had a question on Twitter. A trader asked me, "Hey, what's up with the Aussie and the Kiwi?" Well, I'm like, well, if you look at the stock market, and the stock market closed at new lows on the year, well, chances are the Aussie and the Kiwi are going to come under pressure as a result. Plus, you have the RBA rate decision and RBNZ rate decision also this next week. So, you might have a little bit of a nervous Nelly that own those commodity currencies, but typically commodity currencies are going to get hit when stocks are getting crushed. And we closed at the lows of the year. It was interesting this last week. The last week we fiddled around with new lows on the year. And then obviously by end of month, end of quarter, that was on Friday, the flows were obviously just all selling flows. And so the markets actually closed on the lows. If you remember last week's week ahead video, we talked about the importance of this level, and I said, hey, be careful of a breakdown to 35.80, which by the way, we closed at 35.85, and possible bounce. Go back to the last week's week ahead video, and I was looking for a move down here and a possible bounce. Well, given the fact that we closed at the lows, can we go further? The answer to that question is we can. And so I would be scared being long on Friday, looking for a move, going into next week. Now it's possible we could see a recovery early next week, but I think you can't rule out lower levels at this point. Remember, this is a descending channel. This is also a head and shoulder pattern. And if you just think about like the head and shoulder pattern as a whole, the chances of it continuing to move lower here at this point, towards 34, 3,500, 3,300 is quite high. I mean, just to complete that pattern. Also, if you look at the channel, the channel will take us down towards 34. What was that? What is that? 34.50 or so. grab this drawing tool here. 3450 or so. I mean, so we could really make our way lower if we want to. Now, what could push us towards those levels? I'm going to say that what we have to pay attention to is the data coming in next week. We are in one of those regimes in the market where strong data represents, weak stock markets, or the stock markets just don't want strong data. The stock market wants to see weaker data, because if we get weaker data or data below expectations, that means there is a stronger likelihood that the Fed is going to actually start to, taper its hawkish rhetoric, or slow down its hawkish rhetoric, suggesting to the market that they might be closer to finishing raising rates than later. But we're pretty far away. I think we're still a couple weeks from the next CPI print. This week is going to be all about non-farm payrolls, and a lot of people have been anticipating that the jobs data is going to really start to weaken in the months ahead. And if that is the case, and we start to see weakness in the jobs data, which we're going to have ADP data, we're going to have ISM, both manufacturing and services data, where we can see the employment component. We'll be able to see those early this next week before Friday. When that data starts rolling out, if that data is coming in below expectations, that is one thing that would be supportive of stocks. So just keep that in mind. So let's go back over, so you can see the view of the S&P. You know what I'm expecting with the S&P. Whether we stop here and maybe that was just end of month flows and we reverse those on Monday is to be seen. But remember, last week 3580, that was this big breakout point back over here post COVID. Once we, that was like the straw that broke the camel's back, if you will, in the stock market. Because you remember, this is the previous high. We broke out. We kind of shuffled around a little bit before actually, starting that massive breakout higher in stocks. And that is, in my opinion, that is, a really big level for the market. If we get, much below here, then we should see the lower end of this channel before bouncing. And remember, the completion area for the head and shoulder pattern is 3,300, depending on how you drew the neckline. But let's talk about currencies, and let's go into the FX market, and let's start with the euro. Now, here's a weekly chart that I've referenced to this week on our blog. Now, if you don't know where our blog is, just go to forexanalytics.com, go to our blog, and you can see that there's I'll post a chart of the day, and there's chart of the day right here. Right when we hit that low in the euro, you were notified, and the euro bounced pretty aggressively from that level. I mean, you can see the nice bounce after that chart of the day was published. So the reason why that's such a big level is because that was when the euro got released, was back in right here in 1999. The January 1st of 99, the euro was first used, and then it sold off immediately. And the breakout really was back in 2002. Well, that level was hit this last week when the sterling, came crashing down. So that is going to be really critical support for euro. For the euro bulls, or if you're a euro trader, you just need to know that this 95, 96 cent level is going to be huge. That is the 52-week low is 95.35, and that's going to be really important. So now the question is, what could actually turn the euro higher at this stage? Well, this is where 98.50 really comes into play, right? So if you can see this support right here, and let me get rid of this trend line here. I don't want that anymore. All right, let's take a quick fib and go from the latest drop lower to the low. Okay, and let me put that in. You can see that 50% retracement comes in at 98.60, 98.70, depending on how accurate you are here on your fibs. But that's a 50% retracement. 50% is not a Fibonacci, just so you all know that. And that's also previous support. So previous support, current resistance. So we all know right now, while we're below 98.60, it's hard to be bullish. We break back above that level, that would suggest that we might have a stronger chance of a recovery back towards channel resistance. So if you're asking me, well, Blake, where's channel resistance? Well, I'm going to tell you it's right here. Let's go ahead and take a look. Let's draw that out. Okay, so you can see channel resistance would take us all the way back towards about, it's just above parity at this stage in the game. So, you know, but hey, 98.50 to parity, it's not a bad thing, right? And it's possible. Now, you guys are probably wondering, well, what about the sterling? Well, the sterling, like I said, we crashed to all-time lows. That's lows that we haven't seen since, well, it's not on this. Do we have the data on this chart? No, not all the way back to 1985 on this particular data feed. This is by one of our sponsors, which is 8cap. So, but this is their data on TradingView. Check out 8cap when you get a chance. Great company to work with. Anyway, and a lot of people, the traders that have gone there, actually love them because of their customer support and their flexibility, and all the currencies that you can trade, cryptos that you can trade with them is pretty cool. Anyway, getting back to the sterling. So the sterling, the previous low was 105.20. That was that 1985 low. So we broke those lows and we bounced. Now the question that, you know, we all are asking is, you know, can the Bank of England and can you know, the Bank of England basically, can they save the sterling? Well, if you look at the bounce back from the last move lower, the 618 Fibonacci retracement level was, you know, 112.40. Also, it is previous support is current resistance. If you go back to a 4-hour chart, it's around the 112 level. You can see it right through here, right? And also, it's the underside of the previous channel. So while we're below 112.50, you have to, you know, stay bearish. But if we can get our head above 112.50 in the sterling, maybe that's going to suggest a further recovery. And if you guys really want to play the sterling on the short side, you know, one of the pairs that you might want to look at is you might want to look at the euro sterling. You know, the euro sterling, you know, obviously had a really big move up to 92.50 this week, but we've come back to, you could say, reality. We've come back to levels that are probably consistent with current prices. You know, the spike up was, you know, obviously from that fear of what was happening in the gilt market. But if you take a look at the euro sterling, we are back at those levels. You know, if you want to be long, I think the risk reward is pretty good here when you're saying, okay, well, you know, here's my risk, my reward might be somewhere up here, and current price is right there. Well, then, you know, your risk here, reward there, you're probably looking at least a 1-to-5 risk reward ratio on being on the long side of the euro sterling. So if you want to like get the dollar out of the equation and just want to play the sterling maybe against the euro, which, you know, you saw the euro's at pretty key support. Sterling, we're a little bit iffy about what's going to happen with them. Well, you know, with the Bank of England and what's going to happen with the sterling and the gilt market. Well, there you go. You know, you take a look at you look at maybe some cross rates that might play a little bit better. Now, one of the things I'm going to talk about this really quick regarding the data, and I'm going to stop really quick, and I'm going to talk about two things actually. And let me say this: if you like these videos and you like the week ahead videos, make sure you give us a thumbs up. If you're watching us on YouTube, subscribe to this channel. It's free to do so. It's free to subscribe to the channel. It's free to give us a thumbs up. So that's great, right? So please do so. I'd appreciate it. The team would appreciate it. But let's talk about something else that's pretty important as we go into this next week. So as I was just explaining, good data is bad for risk. You know, the stronger the data is, the less likely the Fed is to shift their messaging. You know, now a lot of people think, well, you know, the Fed is going to be very hawkish for a long time. That may be true, and they're going to keep rates higher for a long time. That may be true as well. But what the market is really trying to cue in on at this point is they're trying to figure out where is the terminal rate, where is that level that the market really is looking at to say that's where the Fed is going to peak and that's where they're going to be done. You know, so you know the terminal rate is my buddy Chris Weston pointed out. You know, here's the calculation on how to get there. The market is actually looking at 4.5%. That's where the market is currently targeting the terminal rate at this point. Great. Well, if that number starts to come down, that is actually good for risk, because that means that the Fed, the the market is anticipating that the Fed might slow down their pace of hikes to get us only to a certain number. So like, let's say that number came down to, 4.25 or maybe 4%. If it came down to 4%, and currently, our rates are at what, 3.25 right now, that means that there's only so many rate hikes left before the Fed is done. So what we're going to start looking for is, weaker data. Weaker data would mean good for the stock market to possibly stabilize this week. Now, how would the market respond to, let's say it's bad data. Bad data equals better for stocks, right? What is the best currency pair right now, in my opinion, that would react the best? Doesn't mean long or short, meaning which would have the best reaction to weaker data, which would be good for risk appetite. What do you guys think? And if you want to add to this conversation, jump down below and jump in the comments and let me know what you think. Well, my opinion is going to be you want to be short the dollar Mexican peso. Now, I'm already short the dollar Mexican peso. Last week we went through the Banxico meeting. Banxico raised rates by 0.75% or 75 basis points as expected. And so we've got the central bank activity out of the way. Now, one of the things about Mexico, and I think is and this is a weekly chart, so I'm going to give you a much longer term view here. You can see, unlike the, let me match up really quick. I'll give you a good example, the Kiwi dollar. You can use the Kiwi or you can use the, the Aussie, right? You'll notice how very inversely correlated charts, right? You got the Kiwi, which happens to be in green, which is a commodity currency, right? You can see how it moves up. Dollar Mex moves down. They're very much mirror image of each other, except until when? Until very recently, right? Until very recently, what we've seen is the Kiwi move down in price. The dollar Mexican peso has not moved higher. One of the reasons why that is well, I think there's a couple of reasons, but one of the major reasons is, the Mexican peso is a North American currency. Also, one of the things about the Mexican peso is the location of where Mexico is. It is a beneficiary of higher prices globally. As prices continue to rise in developing and developed countries like China, right, where we do a lot of our manufacturing, a lot of companies have moved their manufacturing and from China to Mexico because Mexico labor is cheaper than in certain areas than it is in China. And I think that's going to be a big trend that we're going to see in years to come. So when you look at the dollar Mexican peso and we eventually get a recovery in stocks and people start to buy things, what currency are they going to buy? Well, my opinion is, yes, of course, you might get a bounce in the and I'll talk about this right here. You might get a bounce in the Kiwi, where the Kiwi bounces like this. But you know what? Where you're going to get the real bounce is you're going to get the real bounce right here, where the Mexican peso really starts to strengthen against the U.S. dollar, and that starts to move lower at a very rapid rate. Now, one of the things I want to point out about the dollar Mexican peso is and let me go ahead and just delete this really quick. One of the things about the dollar Mexican peso is you can see it's got a really nice base of support. If we start breaking the 1980 level, that's 19.8000 right through here. If we start breaking through that support, the next level of support is going to be basically 1950 and just below that. There's like the 1940s that was traded. We break below that support, there is not a lot of support, takes us below 19. Again, if data starts to weaken in the US, my trade of choice is going to be short dollar Mexican peso. And I want you guys to consider thinking about that as we go into this next week. Okay. Now, one of the things I want to also mention is if you guys have not had a chance to check out the Trader Funding Program, make sure you do so. The Trader Funding Program is, and I'm going to show you the example of what our community looks like. It is a way that you can learn to access our money. You want to trade our money and you want to trade larger amounts of capital? Well, you have to take an assessment, and the assessment is paid, but once you pass the assessment, You can trade our money and make 75% of the returns and take none of the risk. Okay, you have to make 10% without losing more than 5%. It is on a trailing basis. So as you become more positive in your account, that 5% loss trails up with your losses. Now, the thing about Forex analytics and the trader funding program is when you join the trader funding program, you're not there alone. And that's the thing that's probably most important when you trade, is having a community of traders to trade with. Well, not only will you get Forex analytics for a certain period of time, okay, you get this platform, you've got the mobile app, but you'll also be in a chat room. And we have multiple chat rooms, and you have people you can talk to, whether you're talking about our general chat room, whether you're talking about the trades room and seeing where everybody's buying and selling things, or news and research, Flowonomics, which is our macro chat room. There's so much that is given to you to help you succeed, because our goal here is to have you become a successful trader, not to just leave you out hanging on your own. So check out the Trader Funding Program, and also make sure you register for the Trader Summit event. So I'll see you guys there, and actually I'll see you on Monday on the Morning Edge and the Face show, which is our free shows. My name is Blake. I hope you have a great remainder of your weekend. Thanks everybody for tuning in today. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.